Welcome to our outlook for 2026, what we're calling Rewiring Growth. The central focus for investors these days, it's really about artificial intelligence. The big question is, when will it really affect productivity and ultimately earnings? So in this report, we're going to share some articles, some content around things like artificial intelligence, of course, our long-term themes, government policy, our fiscal trajectory in the U.S., and all of this to help frame ultimately our outlook, which we'll get to. But really to serve as another foundation, let's start with a review of what happened in 2025. Now, we started the year with big worries in DC, with changes in DC, and obviously in the end created a lot of angst that sort of peaked on Liberation Day when stocks ultimately fell a lot as the Trump administration announced a bunch of tariffs. And so people were really worried that was going to be troublesome for the economy, ultimately for the markets. But despite what was really a modest decline in first quarter GDP, we saw the economy rebound, honestly, a little bit better than people were expecting, than the consensus forecast. And ultimately, we're expected to have a good year. Consensus is around 2%. But one of the things we've seen the last couple quarters is that the consensus view ends up being a little bit more muted than what actually happens. So there's another model, for example, called GDP Now that's forecasting a little bit stronger fourth quarter growth, for example. Ultimately, we could see GDP grow a little bit higher than 2%, but ultimately a better year than expected. And of course, that translated to better activity when it comes to the market. So another tailwind, by the way, was the Fed ultimately cutting rates 3 times and market rates falling a little bit. But ultimately, stocks rebounded, and we had a very good year. What I want to do is dig in a little bit to stock market performance, because there's been a wide range of results. And, if we start with basically markets outside the U.S., we saw both the emerging and the developed markets outside the U.S. with returns in U.S. dollars over 30%. Now, about a third of that relates to the dollar weakening through the year, but still a very strong result. Another category then that, of course, performed really well were big tech-oriented companies. So think the Magnificent Seven, for example, up well above 20%. And tech stocks in general, so let's say as measured by the NASDAQ composite, up over 20%. Now that serves as a foundation to strong results in what we'd call the cap-weighted indices. So for example, large cap core stocks in the U.S., so think the S&P 500 or the Bloomberg 1000, both very strong returns. Again, remembering that those big tech-oriented companies hold a big weight in that index. So when we neutralize for that and we look at equal weighted, which is, by the way, how often many people invest, we saw returns still positive, but a little more muted, down just above 10, let's say 11%. So we see both the S&P equal weighted, the Bloomberg 1000 equal weighted, having that slightly more muted return. Now, another couple of factors that are also in play. One is yield. So the idea that when we look at a yield-oriented investment, essentially, once again, those types of stocks didn't perform quite as well, especially as these big tech-oriented growth stocks. And then when we layer in quality, the idea of sort of financial strength in a company, for example, basically returns were even more muted. Now, what's interesting about that is you see that in the small cap space as well. So the Bloomberg 2000 having a return just over 11%, but when you layer in really what's a quality filter just by the way the S&P creates their small cap index, it's a much more muted return from there. And then if you layer in their additional quality filters, it's a return just over 1%. And so that's really quite a wide range. The higher end of the non-U.S. markets in the low 30s or so, and then at the other end, quality-oriented smaller companies earning just over 1%. And so the punchline is a wide range. And what we've been telling people is, hey, we think the markets are going to broaden out. Number one, you want to be diversified across all these different kinds of categories, and you want to be careful not to chase the strong performers. These things tend to revert to the mean. Sometimes the winners become the laggards, and vice versa. So anyway, again, a very dramatic year in the market. And again, I'd say that strong performance driven by optimism around artificial intelligence. Now, as to set the foundation for a discussion about AI, I'll just mention our long-term themes. So recall that we have a number that we track. One is productive competition, which might include, for example, competition between the U.S. and China on artificial intelligence or other things. The new consumer, where new forms of consumption are being created and new preferences, AI influencing that. Shifting demographics, of key focus on longevity, for example, and related healthcare needs. AI is sort of involved in that. Securing strategic resources, so think food, water, energy. We see things happening where basically AI is being used to do a better job with farming. Then the fourth industrial revolution, the idea of tech innovation. If it was a few years ago, I probably would have said, hey, AI is really in that particular theme. But the reality is that AI weaves throughout all our themes. And so, again, I want to take a little bit deeper dive into that topic as it relates to us building the foundation for our outlook. So we actually created a special article this year, Artificial Intelligence Runway for Growth. And the idea here is to recognize that really generative AI, I think things like ChatGPT, it's been with us since 2022. And for a while, it was sort of, the question was basically if anybody's going to use AI in a more traditional business sense. That sort of question's been answered. I think everybody knows it's happening. And the question then has shifted to how much and how soon will the capabilities of AI start influencing businesses, ultimately profits and earnings and shareholder value. Now, today it's already affecting lots of sectors. So think of healthcare like drug discovery. Think of virtual staging tools for real estate. Think of fraud detection with financials, for example. So one thing you might have read about through the years, the idea of a potential AI bubble. We're not in the camp that we're in a big AI bubble. These are really usually cash generative businesses making foundational investments either to support or deploy AI in their businesses. So a lot of really good opportunity as we look forward. Now, we will see some headwinds around adoption lags. Really the time also that it'll take for infrastructure to be built. Think something as simple as power to be available for data centers, and then potentially some supply chain issues that could serve as a little bit of a headwind. But ultimately, we're optimistic when it comes to artificial intelligence and its influence on businesses. Now, with respect to other considerations, let's take a step back and look at what's going on in DC and what to expect in the coming year. We're fortunate at Stifel to have Brian Gardner, that's Stifel's Steve Washington policy strategist, and as he does each year, he penned an Outlook article for our publication. And really it's focused on a few things. Number one is that the idea is that 2026 can be a policy-heavy year. Now, it's going to be compressed in terms of the legislative window because of the midterms. And ultimately, topics like affordability will be a key theme when it comes to the election. And of course, we stand here today with, in theory, a unified government and the potential for a divided government. Now, we'll also see a new chair for the Federal Reserve. And ultimately, because of the potential for divided government, there's going to be a focus on administrative policy, so think policies coming out of the administration, as well as monetary policy. And the topics, of course, will continue to be the budget. Maybe there'll be regulation around artificial intelligence and maybe some additional focus in areas like crypto and energy. But ultimately, we'll keep an eye on things in terms of DC, and it will have an influence on how things unfold. Now, staying focused on the government for a bit, let's talk about the fiscal trajectory. We've talked about this a lot over the years, where we see the deficits and the debt here in the U.S. outsized, even as a percentage of GDP. And so we penned an article actually for this Outlook publication called Fiscal Trajectory, Borrowed Time. And here basically what we see is things like economic growth, level of interest rates, level of inflation, and then the political will or not for austerity, meaning higher taxes, spending reductions, etc. All of that will play a role. And in this article, we basically frame up 4 possible scenarios. And we've given basically little names to kind of keep track of what we're thinking. The first is baseline drift, or managed imbalance. This is the idea that we'll continue to kind of kick the can down the road, where we'll sort of try to manage this and try to keep it under control. And as we see it, that means that the problem is the impact of the problem is ultimately delayed, not really solved. Next is the idea of discipline stabilization, reform by necessity. So here we have volatility and interest costs causing basically officials to wake up and realize, gosh, we have to do something about this before things get too problematic. Now, the third scenario is crisis spiral discipline through shock. This would be a break in confidence that this issue might cause, perhaps contributing to a deep recession, a lot of pain, a lot of voter focus on the topic, and ultimately government official, elected official focus on austerity and trying to get things cleaned up. And then finally, the most positive of the scenarios is growth, renaissance, or productive escape. So here are the ideas that we see improvements, meaningful improvements in productivity, let's say from artificial intelligence, for example, and a real pickup in growth that really helps. But even in this scenario, we frame out that austerity in our view will still be needed. So again, I think we're taking a look at this article. It's certainly one of those medium to long-term headwinds that we have to be mindful of. But we sort of frame out these different scenarios. And of course, it might be a little bit of this, a little bit of that when things actually unfold. But it provides a nice framework to understand the issues and the potential future. Now, we do also include our geopolitical risk dashboard, what we call a fragmented world. And it includes things like U.S.-China competition, as I mentioned, the risks of cybersecurity issues, supply chain shifts, the fiscal trajectory that I just mentioned, and even, of course, unfortunately, hotspots around the world when it comes to military situations, global tensions. And so ultimately, all this, artificial intelligence, state of the government, fiscal trajectory, what happened this last year, all feeds into our outlook for 2026. So let's jump into it. We called it rewiring growth. So again, the idea here is that growth drivers are being rewired by AI, which is both influencing CapEx, but also industrial policy and geopolitics. And so we see a shift towards a higher level of long-term growth on average as a result of artificial intelligence. And so this will happen near term when it comes to basically the infrastructure. So think of things like builds out of data centers and the need for chips, the need for power, but ultimately we're seeing this as a potential benefit for normal businesses, right? And the idea that companies can use artificial intelligence, do a better job at what they do it possibly for a lower cost, and ultimately have it amplify their growth. So we're very positive on the influence of AI going forward. And when it comes to our forecast for 2026, we see GDP holding steady or potentially above sort of the long-term trend and the upper side of that range, influenced by the idea of AI spend and monetization, and ultimately the consumer being encouraged. We see 1 to 2 Fed cuts this year, but probably later in the year. We see a continued softening of inflation and interest rates ultimately moving just modestly lower. Ultimately, this all adds up to a stock market that's pretty positive, right? And think of it as that foundation is really an anticipation of earnings growth in the 13 to 15% range. That's sort of in line with consensus, what we're seeing. And maybe a modest contraction in multiples. And ultimately, though, a pretty positive return for this stock market. Now, every year when we do our outlook, we frame out a couple other scenarios, the bear case and the bull case. And so let's run through those. And let me start by saying we're going to anchor on 3 topics related to these scenarios. One is that idea of the impact on AI monetization. Is there actually a translation of investment into earnings? The second is the consumer. The consumer, making up about 2/3 of the economy, is a real driver of the economy. And so where the consumer goes, perhaps the economy goes. And then finally, policy. What are some of the considerations when it comes to policy? And of course, for our base case, we are positive on AI monetization. We're positive on the consumer remaining engaged, and we think things will remain reasonable when it comes to policy. Looking at the bear case scenario, which we're ascribing a 15% probability to, we're calling it wires crossed. Here, the kinds of negative things that could happen is AI monetization. This investment actually disappoints. Results don't start coming through. Maybe companies pull back on their capital investment in this area. Maybe that corresponds with a softening of the labor market, or we see, whether it's monetary or fiscal policy errors, potentially amplifying volatility. On the bull scenario side, we're assigning about a 25% probability to this. We call it wires connected. And here I would say that the theme of this is that things are just better than we're expecting, but directionally headed in the same way. So productivity shows up maybe even faster than we were expecting. The consumer remains very engaged, and policy, whether it's monetary or fiscal, becomes more clear and more supportive of the environment. And so, ultimately, that would result in even better results in 2026 if that was to unfold. Now, next up, allocation insights. The idea is, okay, now with all of this thinking, what does that mean for portfolios? So as I mentioned, in the wake of the strong performance that we saw in areas like big tech, this is a particularly good time to think about certain things like rebalancing. If you become overweight equities based on your long-term policy, consider rebalancing. If you have a very focused portfolio, consider broadening it out, become more diversified. Think regions, sectors, styles. We think it's a good time to focus on quality looking forward. Now, in the fixed income area, if you've been away from fixed income, with interest levels and yields up where they are, it's an attractive time to be looking at fixed income. And then, of course, for those clients that are interested and where it's appropriate, considering alternative investments for either return enhancement or diversification. Now, in the overall report, essentially, we do include a few other things. We have a little overview, as we always do, about our investment process, Stifel's approach to asset allocation, and where to find our guidance. It's at stifelinsights.com. So listen, I really want to thank you for taking the time to check out this video. We'll have a client webinar coming up, so if it's before that, and that'll be about mid-January, check it out. If it's after, you can check out the replay. Thanks so much for checking this out, and we'll see you soon.